now. We can get started. So before we jump in, a few things I want to highlight to everybody. First of all, for those of you that don't know me, my name is Ryan Melliker. I am president and co-founder of Lodging Analytics Research and Consulting, or LARC, as we like to call it. And you are here for the March 2024 U.S. Outlook presentation, our quarterly webinar that we like to provide to the industry on a complimentary basis. Before we jump in, a couple things to note. In your Zoom taskbar, hopefully you guys are all familiar with that by now, there is a Q&A option. Feel free to load a question into the Q&A. We will save some time at the end of the presentation to walk through your questions. Katie Harding, who's on with me, works with me at LARC, is going to moderate that Q&A. So feel free to load those questions in at any point in time as we walk through the presentation. We'll go through them all at the end. If for some reason we're unable to answer your question during the presentation, feel free to shoot us an email at information@larcanalytics.com. That's information at LARCanalytics.com, like you see on the screen right now. And we'll respond to you as quickly as we can. Two other things that I'll highlight to you. Number one is this is being recorded. So if you miss it if you have to hop off for one reason or another, don't worry about it. We'll be able to go ahead and send over the link to the recording, after the presentation is over, and we'll also be posting on our website, so fear not. And then the third thing that I'll highlight is that I know we're gonna get this question at least a few more times, throughout the next hour. But yes, everybody that's on the webinar will receive a copy of the slides. We will send them out to you. You don't need to ask for them, you will get them. That being said, we're gonna jump in now. There's a lot to get through. So I am gonna go ahead and get started right now. And with that, here we go. So this is our agenda for today, and I'm going to start with kind of a recap of what happened in 2023, but maybe a little bit different than you may have seen before, other people have highlighted to you before. So, as we look at 2023, one of the things that I think is really important to think about is 2023 was really a tale of two different periods. The first period was the first quarter, where growth was really, really strong. Supply remained muted, but demand growth on a year-over-year basis, occupancy growth, ADR, and RevPAR were all really strong. That was largely fueled by soft comps from the Omicron variant in 1Q of 2022. Then as we moved forward to 2Q, 3Q, 4Q, you saw really, really muted growth, where supply remained muted, but demand was negative in each of the three quarters. Occupancy was negative in each of the three quarters, and ADR growth was sluggish, resulting in RevPAR that gradually decelerated from 2Q at 2.5% to 1.7% in 3Q to 1.3% in 4Q. Now, a lot of people will talk about, well, hey, LARC is forecasting RevPAR growth to decelerate from 2023 into 2024. And that is true, but we're also forecasting RevPAR growth to accelerate from these last few quarters of the year into 2024. And, so I think that a lot of it comes down to what your baseline of expectations is. At the end of the day, we feel like we have a pretty positive view, just not as positive as maybe some other guys, and we'll talk about that in a minute. Some of the things that are really important to think about is if you look at those 2Q through 4Q averages, supply was pretty muted at 0.3%. Demand ended up being negative at 0.6%. Obviously, occupancy almost a point in the negative side. ADR was up 2.8% and RevPAR up 1.9%. Now, keep in mind, that was coming as GDP growth was strong, right? We saw 2.1% GDP growth in 2Q, 4.9% in 3Q, and 3.3% in 4Q. So you had strong GDP growth. Nobody's expecting that type of strength in GDP in 2024. And that led to RevPAR growth that was in this level that was really muted. So there are some things to keep in mind as we look at kind of the outlooks for 2024 that should give us all a little bit of pause in terms of, well, are things really going to accelerate and or quote decelerate from 2023, and then how much? But that's just kind of a good backdrop for what really happened throughout 2023. Now, what happened nationally isn't necessarily what happened in every individual market. here's the 61 markets that we issue forecasts for on a quarterly basis and their year-over-year growth for 2023. And what you'll see here is that there's just a tale of 61 different markets, right? You've got super positive growth year-over-year basis, up close to 20%, in markets like DC and Las Vegas and New York. And then you've got markets down over 10%, like Florida Keys, Santa Barbara, New Orleans down meaningfully as well. Massive divergence, right? At the end of the day, the top markets tended to have outsized exposure to corporate transient demand, strong inbound foreign travel recovery, and positive group trends. Vegas also benefited from the Formula One and other special events, and they'll do so again in 2024 and beyond. Bottom markets tended to have outsized exposure to domestic leisure travel and soft group demand. What we will tell you is if you look at most of these markets, the low end of this chart, most of them still relative to pre-pandemic levels are the winners. Even being the biggest losers in 2023, they're still the winners over the long term. And that's something important to at least pay attention to. When we move beyond the top line, what you'll see here is 2023, data for OCC, ADR, RevPAR, hotel EBITDA, and values. Now, one of the things that we think is kind of important here is RevPAR actually was driven by 90% of RevPAR growth was driven by ADR. And when you're looking at that type of large amount of RevPAR growth driven by ADR, it should translate into pretty strong hotel EBITDA margins and flow-throughs, right? But we only saw 7.8% hotel EBITDA growth. Well, that's good. Obviously, it's a good year. We would normally hope for a little bit of a better year with that type of ADR growth and that type of percentage of RevPAR growth coming from ADR. So what happened? Well, you had elevated wage growth, insurance costs being up massively. All those things weighed on hotel EBITDA. And then when you look at values, values weren't up nearly as much as hotel EBITDA. You might say, well, why not? And the answer is real simple. I think the primary one is cap rates expanded 30 basis points in 2023. The secondary one is that the outlook for forward cash flows started to moderate in 2023. And that started to impact, hotel values in the year as DCFs looking forward got a little bit more muted. So moving on to where things are going to be moving forward and some of the factors that we really focus on. We're going to start with some of the factors that drive corporate transient demand. Return to office is something that we talk a lot about, and we talk about it on every one of these quarterly webinars. And every quarter, we tend to have a bit of a nuanced view on return to office. The reality is, over the past 6 to 8 months, there have been a tremendous number of corporate mandates returning, requiring employees to return to the office in some capacity, whether it be part-time, 2 or 3 days a week, or a certain number of days a month, or you name it. The reality is, as you see by these headlines that have come out over the past month or so, companies are having a hard time getting employees back to the office. It just isn't working as well as they had hoped, and certainly as well as we had expected over the past 6 months. The reality is we're not seeing that return to office accelerate or reach any type of inflection point, despite the myriad of return to office mandates from some of the largest corporations in the country over the past 6 months. And that gets, while we all know it from the data that we see, and you look at ridership on different, public transit dynamics, you can also look at Castle Systems data, which is one of the easiest ways to get a sense of how things are trending. Now, we're the first to admit that Castle Systems data is not the end-all be-all when it comes to office utilization rates, but we think the trends are indicative. Do we think office utilization is at 50% of 2019 levels today? No, we do not. But we do think that what's happened over the past 12 to 18 months, which is very muted growth in terms of that office utilization, is very real, and that's what we're seeing. And it's probably what we're going to continue to see over the next 12 to 18 months is a continued, very muted growth. We're not seeing an acceleration. We're not hitting an inflection point. At the end of the day, we don't believe office utilization rates will ever revert back to pre-pandemic levels. We think or at least not in the foreseeable future, the hybrid work environment is here to stay for the foreseeable future. And while we think that things will gradually, ever so slightly, continue to tick up, it's not going to translate into this big inflection point, which is a different view than we have had in the past. So that's something to keep in mind. We changed our tune on that a little bit. We thought all those mandates were going to translate into better return to office, and they have not. And now we're accepting the reality that we're in a situation that we're in the situation that we're in today. Now but there's still continued gradual recovery, which is a positive, right? Corporate transient will continue to gradual recovery from that perspective. The other thing that's a positive is taking a look at corporate profits in the stock market. So corporate profits were actually down 4% in 2023, but they're forecasted to be up in 2024, though down a little bit in 2025. Corporate profits are also expected to be 20% above 2019 levels this year. Stock market's up 10% this year after being up almost 25% last year. It's over 60% above 2019 levels. The reality is factors like corporate profits and stock prices are not limiting corporate travel like you would normally expect them to in an environment where we don't have much corporate travel growth, and where corporate travel just hasn't recovered. It's not these factors. These factors look good. The challenge is that people aren't in the office. If people aren't in the office, 5 days, the extra day of the week, you don't have a reason to stay that extra night, or even to go visit that person because they're not in the office. And maybe you don't do that trip at all because they're not in the office that week. So those are factors that are weighing on the pace of corporate transient growth. But the bottom line that I'll highlight is it's still growth. There's still movement in the positive direction for corporate transient, and we expect that to continue through 2024 based on some of these metrics. But moving beyond corporate transient, we can talk about group a little bit. When we look at group, one of the factors that we really focus on is convention center bookings. We tracked the 30 largest convention centers across the U.S. These convention centers in 2023 had really strong bookings where their definite room nights booked were up 14% year over year. 2024 is positive. It's up 3% year over year. That's encouraging, positive. That's a good thing. But at the same time, it's not amazing, right? And it's certainly a deceleration from where we were in 2023. So that's something to keep in mind. Some of the strongest markets, as you see on the slide, Seattle, DC, Charlotte, some of the weaker markets, Salt Lake, San Francisco, Austin, Tampa. Couple things to keep in mind about these is we don't think this is where those convention paces are going to end the year. We expect the positive ones to moderate a little bit and the weaker ones to improve a little bit as we go through the year. But nonetheless, there are markets that are going to have headwinds from convention pacing data and markets that are going to have tailwinds from a convention pacing data. But overall, across the U.S., we're looking at a pace that is positive, up about 3% this year, before it's currently tracking down 2% next year, which is something to be mindful of. It's only down 2%. There's still time to make that up. We think that that's unlikely to be made up given the strength of bookings in the back half of 2023. We're more expecting to see convention booking pace down next year than we are up. Not just based on where we are today, but based on how strong bookings were in the back half of 2023. And we're not confident you're going to see that again in 2024. We'll see. But given the presidential election and some other factors, we would say that's probably less likely. But that being said, we think that's a risk for 2025. But 2024 is still pacing positive, which is encouraging. Beyond group, we'll now talk about leisure. And as we talk about leisure, I want to talk about the health of the U.S. consumer, which obviously is a primary factor when it comes to U.S. leisure demand. It's not the only factor, but it's a primary factor. The February Consumer Sentiment Index dropped 2.1 points to 76.9. It's well below pre-pandemic levels and the levels immediately following the pandemic, but it is up from recent troughs, right? February Consumer Confidence Index dropped 4.2 points to 106.7, similarly below pre-pandemic and the levels immediately following the pandemic, but up from recent troughs. And the Consumer Expectations Index still remains below 80. It dropped to 75.2 in February. 80 is generally the metric that they view as like the below 80, there is a risk of recession in the next 12 months. We're not forecasting a recession. Moody's is not forecasting a recession, but it just points to the softness of the US consumer. And then if you look at Deloitte's Consumer Financial Wellbeing Index, it's also improved from its trough in the fall, but it's still below early 2023 levels. And importantly, if you look at this little chart over on the right, you'll see leisure travel intentions from the Deloitte survey. And what you find there is that leisure travel intentions over the next 3 months are up from where they were in the fall, which was really, really soft. But we're still basically where we were this time last year, and we saw what happened with leisure travel in 2Q, 3Q, 4Q, and 2Q, 3Q of last year. So that's not really overly encouraging. I'm not saying things are going to go down a lot from where we were last year, but they're not going. But the dynamics aren't pointing to things going up meaningfully either from a domestic leisure travel perspective. The other thing to keep in mind when you think about leisure travel is personal savings rate. The reality is when people save more, they spend less. When they spend less, they save more, right? Or when they save more, they spend less. When they save less, they spend more. Makes sense, right? There's a negative 86% correlation between the U.S. personal savings rate and the share of wallet across the U.S. Associated with food service and accommodations. So that discretionary spend is incredibly closely tied to savings, right? Well, the outlook for savings is to move up over the next few years, as you see right here. And as that savings rate continues to increase over the next few years, you're going to see pressure on the consumer choosing to spend for leisure travel. Doesn't mean they won't take as many trips, but they're looking to spend less. And that is something that is important and worth being mindful of. Now, that being said, there is a silver lining. We talked about this last quarter. We talked about this at the Alice conference, and we'll talk about it more here. International travel is the upside, right? And this is the surprise, the win across the market. So when you look at foreign inbound travel, there is great data from the U.S. Department of Commerce, where they're literally tracking passports that are coming through every airport, every point of entry into the U.S. And foreign inbound travel volumes across the U.S. in 2023 were 16% below where they were in 2019. So there's a lot of recovery remaining. Importantly, that recovery is happening and it is trending pretty well. You can see that general trend moving from close to 25% below 2019 levels in January of 23 down to about 8% of 2019 below 2019 levels here. So big improvement as we moved through the year. That is very encouraging. We think that will continue to gradually improve, and we'll talk about that in a second. But that is encouraging. The flip side of that is something that a lot of us may already know, which is that U.S. citizen international departures, so outbound foreign travel, was up big in 2023. In fact, it was 11% above pre-pandemic levels. Now, that shouldn't be too surprising. It points to the level of pent-up demand for leisure travel for international destinations coming out of the pandemic. It also points to, hey, there's some easier comps for this, right? This isn't going to continue to accelerate, right? And if it doesn't continue to accelerate, things are going to get a little bit better, or at least less bad from this perspective, which is a positive. However, while I would say that's true, the counterpoint to that is, if you look at the trend is not encouraging, right? We've generally been trickling up. The last 5 months of of data that we have are the 5 strongest months that we have. So while we hope that things maybe are plateauing here, which would be good, we aren't sure that that's happening yet, and there's still obviously a leg up relative to the first half of the year that we'll likely see from that perspective. Now, why do we have confidence that this is going to continue to move up and maybe this stabilizes or trends lower? Well, it has to do with the US dollar. When the dollar's increasing in value, like it was, basically increasing in dollar during this whole period, going up, peaking, and still increasing, just not increasing as much up through 2023. When the dollar increases in value, U.S. destinations become more expensive for foreign travelers to to visit, and foreign destinations become more affordable for U.S. travelers to visit. On the flip side, when the dollar decreases, the opposite happens. Foreign travelers find the U.S. to be on sale, and U.S. travelers say, "Hey, these foreign destinations are really expensive now. We don't want to go spend that amount of money more than we were expecting because of the change in the dollar." And guess what's happening starting in 1Q 2024, really all the way through 2026, or at least into 26, the dollar is expected to decline with the biggest year-over-year decline, in early 2025. So there's some pretty encouraging signs related to the U.S. dollar, which we think will actually point to positive tailwinds for foreign travelers coming in, and headwinds for U.S. travelers going abroad, which will be encouraging, but it's going to take some time for all of that to play out. Now, that being said, what I will tell you is not every market is created equal. So of the 61 markets that we track on a quarterly basis, 34 of them have what we call a reasonable exposure to foreign inbound traveler, where it's relevant. When I say relevant, what we're doing is we're looking at the number of annual visitations in 2019 from foreign inbound travelers as a percentage of total demand in the market. Now, visitation is not a demand metric, so it's kind of apples and oranges, but it gives you a good sense of whether a market is generating a lot of international inbound demand or not. I'm not saying Miami here has 44% exposure to foreign travelers. I'm just saying that that ratio is 44%. That's the highest that we have across the market, across the country. And as you look at these metrics, most of this shouldn't be too surprising. Miami's really strong. New York is pretty good. And then you've got a bunch of markets in the 20s, followed by a bunch of markets around 10. And then you get some smaller markets that don't have a lot of international travel, like Pittsburgh, Cincinnati, New Orleans, Nashville, Raleigh, Austin, San Antonio. They have some, but not a lot, right? Very minimal. But just because you have a lot of exposure doesn't mean you have a lot of upside, right? And this is taking a look at those top 16 markets in terms of how much they recovered to 2019 levels in 2023. And what you'll see is that Dallas exceeded 2019 levels. DC, given the government-oriented nature of a lot of the foreign travel to DC, was already back to 2019 levels in 2023, whereas the rest of these markets all have upside to go, with Honolulu being the biggest, with basically only half of their 2019 foreign travel demand or foreign inbound arrivals materialized in 2023. So plenty of upside there. Las Vegas is still 25% below 2019 levels. And what I think is kind of interesting is most of the rest of these markets are all in the relatively same area of down 12 to down 18%. I personally, when we ran these numbers, I was expecting San Francisco to have far more upside than markets like New York and Miami, which obviously we've seen strong recovery, but that's not necessarily the case. So just interesting to kind of point out some of these numbers where the story may not, the data may not necessarily support the story that we're thinking or what we're telling ourselves. Now, that being said, the one other thing that I think is really important to highlight with regards to 2024 is the reality that this is a presidential election year. And for those of you that read our client letter that we put out last week, it's something that we're paying really close attention to. The reality is, if you look at this data, what this data is showing is the year-over-year change in each of these metrics. So change of each of these metrics growth. So what was GDP growth in 2000 versus 1999, 2004 versus 2003, et cetera? Did growth accelerate or decelerate for each of these metrics during the presidential election year? And what you'll see is that, generally speaking, growth decelerated. Now, you may look at me and say, yeah, but you can't really take into account 2020 and 2008. I'd say you're probably right. Even if we don't believe those extreme declines of 2008 and 2020 are good comparisons for 2024, and we don't, given 2008 was the great financial crisis and 2020 was the pandemic, the other years still paint a very, very similar picture, where you've got negative growth, generally speaking, or decelerating growth, generally speaking, in GDP, business investment, hotel demand, and RevPAR. Business investment, 5 of the past 6 elections has been negative. Why are these things negative? Well, what happens is as politics gets more and more polarizing, I think I read a headline this morning that said something along the lines of this election is unique in that that we've never seen a presidential election where the two likely candidates are more hated, with Democrats absolutely hating Donald Trump and Republicans hating Joe Biden, and this whole concept of this polarization that we have across our presidential politics gets very, very challenging. And because of that, creates a tremendous amount of uncertainty where you're excited about, where a lot of consumers and businesses might be excited about one outcome and fearing another outcome. And when that's the case, you're not sure what you want to do. There's that level of uncertainty and that swing in what it means to your business or if you're a consumer, your wallet, that you may be then oftentimes in this polarized world, we're taking a wait and see approach and not spending as much. And that's exactly what we saw happen. You look at these last 4 presidential election years for business investment, we saw a material deceleration in growth of business investment. And unfortunately, that translates directly to hotel demand, where we've had 4 straight years of negative growth or negative deceleration in hotel demand growth. Same thing for RevPAR, 4 straight presidential election years of decelerating RevPAR growth. We're not saying it's going to be like 2020 or 2008, but we don't think 2012 or 2016 are far off what is in the realm of possibility in terms of deceleration. And that is a little bit concerning as we think about that. Now, as we look at our overall economic view that shapes our market, and our economic forecast comes from Moody's Analytics, I'm going to highlight a few things here. Number one is consumer confidence is the only indicator that's actually poised to improve throughout 2024, up 2.2 versus 1.6. GDP is an interesting one, and this has to do with the strength in the back half of the year and the quarterly annualized growth rates. Taking into account the back half of the year, you actually see a 2.3% growth for the full year, but the quarterly growth is closer to 1.5% each quarter on an annualized basis. Much more muted. It's just that high because of the strength in the back half of 2023. Job growth decelerating, almost cutting in half. Unemployment moving up, inflation moving down, profits similar to GDP. Strong back half of 2023 will translate into positive profit growth, but on a quarterly basis, we're looking at negatives on an annualized basis. And then foreign exchange rates are going to be are going to decline, as we talked about. And then the U.S. 10-year Treasury yield is going to tick up ever so slightly in 2024 from 2023 levels, but below 4Q 2023 levels. So that paints the backdrop of what frames our U.S. outlook for the hotel industry. That being said, some of our key assumptions. We've got the Fed raising rates quarterly starting in mid-2024, 25 bips a quarter. Inflation will continue to gradually moderate, as you just saw. The conflicts in the Ukraine and the Middle East won't escalate. And there's no near-term recession, though we're looking at muted economic growth over the next couple of years. All right, let's talk about the lodging outlook. That's what you guys all are interested in, right? So as we talk about the lodging outlook, first thing I want to highlight is our view on the segments. Corporate transient, and everything that I just talked about kind of points to our views here. Like we just mentioned, we expect a continued modest increase in corporate transient demand, approaching 90% of 2019 levels this year, and ultimately stabilizing around those levels. Group will also tick up this year, continue to tick up as we move through the next few years, stabilizing around 10% above 2019 levels. And then leisure demand will continue to moderate slightly in 2024, but will remain a larger component of demand than it has been historically. Overall, we're expecting leisure demand to be around 115% of 2019 levels in 2024, which is around where it will stabilize. When we think about supply, we expect supply to be muted going forward. That being said, while it's muted, and this is good, it can't really be as muted as 2023. 2023 was an extremely low supply growth year with just 0.3% of supply growth. Keep in mind that a nice chunk of rooms were taken out of inventory for migrant housing. That's something that is unlikely to happen in 2024. We're not going to see an an increase in those rooms. I'm not saying those rooms come back. I'm just saying we don't have that tailwind from a supply growth perspective by rooms coming out of inventory. We're going to see a modest tick up in supply in 2024 and again in 2025. Overall, we view supply as very, very muted and benign over the next few years. There are markets where where supply is a risk, but supply is looking great right now. When we look at our RevPAR model, this is our RevPAR model. And for those of you that want help in understanding what this RevPAR model kind of shows, basically what we're trying to say here is that the dark blue line is RevPAR as reported by STR or CoStar on a seasonally adjusted basis going back to 2000. The light blue line is the model that we've built based on information that we know today, back tested based on all that information we know today. We know about the pandemic. We know about the great financial crisis today. And we've built a model based on all of these factors that has forecasted RevPAR historically for the past 24 years with a 98.7% R squared. For those of you that don't remember your stats class from college, that basically means that our model has forecasted 99% of all the variability of RevPAR for the past 24 years. So highly accurate historical model. And then our forecast moving forward that you see right here is driven by Moody's forecasts for these core metrics. Same thing for ADR that you see here. The metrics are a little bit different, 98.8% R squared. When you put it all together, you see our forecast here, where you'll see occupancy. We expect to tick down about 0.5% this year to 62.6%. ADR up 3.1% this year, and RevPAR up 2.6% this year. We'll then see a gradual deceleration and then going negative in 2026. We had been expecting negative in 2025. That has been pushed out to 2026. LARC is now the most cautious of all the major forecasters in terms of occupancy and RevPAR growth in 2024. That being said, we are also the most positive in terms of ADR growth for 2024. We are more positive on ADR and much less positive on occupancy. And it points to all those points that we just highlighted. And like I said before, if you go back to that first slide that I showed you, the last 3 quarters of the year, we're at 1.9% RevPAR growth. We think that ticks up to 2.6% in 2024. Sounds incrementally positive, right? But it is below that 4.9% that the full year ended up being at. We are not quite as positive as most of these other guys that are forecasting RevPAR growth to be stronger. We just don't see it from a demand perspective. When you look at things on a quarterly basis, you'll see how quarterly metrics start to flow. Generally speaking, we expect occupancy to stay negative through the first half of this year, ADR growth to be strongest in the first half of this year, and then that negative occupancy coupled with the demand mix shift will catch up a little bit with ADR, and we'll start to see ADR growth moderate in the back half of this year. Net for 2024, RevPAR growth for every quarter is going to be in that 2 to 3.5% range. Not big movement. We're not seeing a big acceleration as we move through the year. Or deceleration for that matter. And then as you look to 2025, we've got a little bit of a more cautious view where occupancy growth is positive and then starts to turn negative by the end of 2025. ADR growth remains muted, which means RevPAR growth, which is somewhat positive at the start of 2025, ends up being negative by the fourth quarter. We look at price classes. What we'll highlight here is that 2024 growth is going to be strongest in the luxury and upper upscale segments. Again, this is tied to group, improving corporate transient, and foreign inbound travel, international travel recovery. Meanwhile, the mid-scale and economy segments, which are much more tied to domestic leisure demand, we see continuing to wane this year. And if you look at those metrics relative to 2019, you'll see luxury is the clear winner. While all the other segments range between 9 and 13% above 2019 levels this year. So relatively close to one another, with luxury really being the clear winner. Now, why should you rely on our forecasts? Great question. I think people ask me or should ask me that all the time. And the answer I always tell them is there's a couple of reasons. Number one is our approach is different than everybody else. We believe we are very strong believers in the concept of better data in equals better data out. And when we talk about that, what we're really referring to is using only the best data providers for everything that we do. Sometimes that might be data that we have internally or we've curated internally. Other times it's a third party. And here are some of the third parties that we use. From a historical operating results perspective, we are big believers in STR/CoStar. Historically speaking, we think they have by far the best, the most detailed, and the most elaborate operating results data. To give you some perspective, according to STR, in 4Q 2023, national RevPAR increased 1.3%. According to one of the other major data providers, national RevPAR in the same quarter decreased 1.9%. That is over 3 percentage point disparity in RevPAR growth nationally. I can only imagine how wide that disparity is in certain markets. The quality of the data matters. And we strive to use only the best. We use Moody's Analytics for economic forecasting. We believe they are the best at the market level. I believe we are the only forecaster from that slash page I mentioned before, and anybody else I know of, that actually tracks convention pacing data and incorporates that into our models. We build that into our forecast. We think it's a huge differentiator. Convention centers generated over 16 million room nights in 2023 across the US, or more than that, but across the 30 convention centers that we track, over 16 million room nights. It is a big number, and to understand whether how that's performing can have meaningful impact on forecasts. Supply data, we use all the major providers, short-term rental data, historical cap rates, you get the idea. But our view is better data in equals better data out. Unfortunately, it has generally led to better results. So this is, if you look at this forecast, this is the forecast that we had as of the end of 2020 for 2021 versus actual results. And you can see we were the closest of all the major forecasters, outperformed. We were the best for occupancy, ADR, and RevPAR. If you think that's an anomaly, here it was again in 2022, where we were super close on occupancy. We were the highest in ADR by $6, and we were still light, but we were still the closest. And importantly, despite the fact that we were already out on a limb, $6 above anybody else, we also warned our clients that we thought that in our December 2021 client letter, we warned our clients that we thought our 2022 ADR outlook was a little light because we didn't think our models were accurately reflecting the impact of elevated inflation, because we had never seen inflation like the levels being forecasted for 2022 for any period that we had ADR data. So we said we think that there's more upside here than played out. That's exactly what happened. And then when it comes to 2023, I'll be honest, we weren't the best. PwC was the best forecaster for 2023, but only us and PwC were within 1.5% in both occupancy and ADR for 2023. Other guys, while they may have been close on RevPAR, it was, I would argue, a little bit of luck where they really missed on one end and then missed on the other end in the opposite direction, and it balanced things out. Whereas us and PwC were closer on both. And then at a market level perspective, for RevPAR forecasts issued at the end of 2021 for 2022, we were more accurate in 70% of our markets. And on average, we were more accurate by 1.9 times. What that basically means is that if we missed by 1%, they missed by 1.9. We missed by 2, they missed by almost 4. We missed by 3, they missed by almost 6. You get the idea. And then for 2023, same thing, almost 70% of our markets. And on average, we were more accurate by 90 basis points. We missed by 1, they missed by 1.9. We missed by 2, they missed by 2.9. You get the idea. And excluding the outliers of San Jose and Minneapolis, we would have been more accurate by 125 basis points on average. San Jose and Minneapolis were extreme outliers because we had expected different dynamics. San Jose, we thought corporate transient was going to snap back a little bit, but the Silicon Valley Bank crisis and closure in March triggered a much slower recovery in 2023 than we had expected in San Jose. And then Minneapolis had a couple other confounding issues, especially tied to the convention center, that weighed on that market that we were not forecasting. We got those wrong because of those changes. Otherwise, we would have been even stronger relative to peers. All right, let's move on from the top line and talk about the bottom line. As we talk about the bottom line, expense growth going forward is expected to moderate. That's encouraging, from 3.8% in 2023 down to 2.4% in 2024, hover around there in 2025. And then in 2026, we have it really slowing. That's because occupancy is going to decline in our forecast. So it's not so much driven by expenses on a per occupied room. It's just overall expense growth moderating. Property taxes over the next 5 years, we expect to increase at a 4.2% CAGR, wages at a 2.8% CAGR, which is basically stabilizing from the recently elevated levels. Insurance expense growth will remain elevated, but it's not going to be what it's been over the past couple of years. We've obviously seen big numbers there. It's gonna remain elevated, but won't be to the same extent as others. And you put it all together, and we've got an EBIT outlook that's positive, as we talked about, for 2024, up 3.1%, driven by ADR driving over 100% of RevPAR growth, and expense growth moderating a little bit. But then we've got negative EBITDA growth the next couple of years before things start to turn positive towards the end of our forecast. Moving on, cap rates. Here's our cap rate model, just like our RevPAR and ADR models. 98.5% are squared. You can see the drivers here. And when we put it all together, you end up with our current U.S. hotel industry forecast. Now, when we look at this U.S. hotel industry forecast, what I'll tell you is that for 2024, we expect supply growth to increase from 0.3 to 0.6%. Demand, we talked about, was going to moderate, and we've got it moderating about 0.8 percentage points. Again, not anything like what we had seen in 2008 and 2020 presidential election years, but more similar to 2012 and 2016. That leads to negative occupancy growth, down 0.5%. ADR, however, is going to be strong, fueled by continued strong group booking paces, improving corporate transient demand, and that foreign international inbound arrivals improving, which gives us stronger ADR. As a result, RevPAR is up 2.6, EBITDA up 3.1, as I just mentioned, because ADR growth is so strong that's going to flow to EBITDA, which is encouraging. And then values are going to be up 4.9%. Moving forward, we see a lot of those numbers starting to moderate, but overall, we've got positive growth in RevPAR, in hotel values, et cetera. How has this forecast changed from last quarter? Well, we got a little bit more conservative on supply. We got much more conservative on demand. As we talked about earlier, that's really tied to corporate transient, taking a much more cautious view there. As a result, occupancy got a little bit more conservative for 2024. ADR a little bit more positive, so RevPAR is a little softer. Hotel EBITDA is better because ADR is so much stronger, and expenses have moderated a little bit. And then as a result, values have come down ever so slightly in terms of year-over-year growth. Most of that is tied to a more conservative forward forecast going forward. When you think about the DCF, not just about cap rates on in-place cash flows, but a forward view. We talk about hotel values, how it values this cycle compared to past cycles and where things are going. And this is really what I want to focus on. So obviously, the values fell basically a similar level as they did following the great financial crisis after the pandemic, but they snapped back much, much faster following the pandemic. And where we are right now is around here. And what we're ultimately seeing is that growth is starting to slow here, whereas during the great financial crisis, it took a little bit longer for things to pick up. Why? Because there was the capital markets are the big reason, and that's the big difference. So coming out of the great financial crisis, capital markets were still fairly conservative and tight, right? So you didn't see these high LBOs that drove a tremendous amount of transactions and really boosted property values, right? It was a little bit more gradual, but as we moved through the cycle, what happened was interest rates stayed exceptionally low. The capital markets loosened, and you ended up seeing the values that continue to tick up. What's different now? Well, interest rates are nowhere near what we're seeing during this period of the last cycle. We're looking at interest rates that are going to be materially higher. It certainly seems that way. Higher for longer is the mantra, right? And that we think weighs on. Not saying it puts a pressure on values, just limits the upside. Whereas during the great financial crisis, we saw a lot more upside. So that's a bit of a different view than we've seen than you may be thinking about in the past. It's a nuanced approach. Let's talk about markets, right? Now, these are the 61 markets that we issue quarterly forecasts for. The left-hand side of the page are our full market reports. Right-hand side of the page are forecast reports that really just focus on the top line, the factors that drive hotel demand, pricing power, and forecast for supply, demand, occupancy, or RevPAR, rather than forecast for hotel EBITDA and values, which you see on the right-hand and left-hand side as well. Before we jump into the markets, what I'll highlight is the relationship between GDP and RevPAR growth at the national level is very, very real. Historically, that relationship is very strong, as you see by some of these metrics. And since 2019, it's also been very strong, if anything, even stronger. But what you'll see is that relationship, you saw good GDP growth over these past few quarters, but you didn't see much in terms of RevPAR demand growth, right? So it'll be interesting to see what plays out going forward as that starts to decelerate. What are we going to see here? When we look at how that relationship works at the local level, it totally breaks down. It was never nearly as strong. Correlation was 42%, R square of 18% from 2000 to 2019 for STR's top 25 markets. But across the 61 markets that we track since 2019, correlation is only 3.1% and the R squared is 0.1. So what I'm trying to get at here is what drives hotel performance is not as simple as taking a look at economic growth. You have to understand what drives that economic growth, and whether those drivers are actually going to drive hotel demand or whether they will not drive hotel demand. And we see people get into this, mistake time and time again. And we'll walk through that in a second. I'm going to show you a great example of it. 2024 RevPAR outlook. Here, what you'll see is our year-over-year growth for RevPAR for the 61 markets that we track. On the left-hand side of the screen of the chart, you'll see some of our strongest markets: San Jose, Seattle, San Francisco, Honolulu. All markets that are going to benefit from Asian international demand. Many of them corporate transient recovery, strong group paces in markets like New Orleans, Las Vegas, and Chicago as well. And then on the right-hand side of the page, you've got markets that predominantly catered to domestic leisure demand: Omaha, St. Petersburg, Portland, Maine, Palm Springs, Tampa. Kauai may be the exception, which benefited materially from the Maui wildfires in 2023. So that's just a really tough comp for them. Most of these markets, what I'll highlight, are still top performers versus 2019 levels. So just because they're going to have a challenging 2024 doesn't mean they haven't been long-term winners, and we don't believe they will be long-term winners. That's not the case. We're pretty big fans of a lot of those markets. We look at a 5-year RevPAR forecast. What you'll see here is on the left-hand side of the page, top performers had either really soft 2023 comparisons: Maui, the wildfires; Portland, Raleigh, Seattle, all had really soft 2023s, or they're strong markets going through what we would call seismic shifts, if you will, in terms of the demand structure. Las Vegas adding sports tourism, special events, as well as more economic growth and corporate transient demand. Palm Beach, massive corporate transient demand coming in there, transitioning that market. So that's pretty positive too. Right-hand side, bottom performers. These are performers that lack material international travel demand, have sluggish economic growth: Kansas City, Cincinnati, Omaha, Dayton, Indianapolis, and have soft convention calendars. That's Austin. Or Boston is just really tough comps. Boston had a really outsized growth in 2023. We're going to see a pullback from that. It's just a tough baseline for them to build off of. And then we look at 5-year outlook. For values, our top markets: Vegas, we talked a little bit about. We really, really like Vegas over the next few years. I think there's a lot of upside there. LA, we think LA is a great market going forward. When you think about LA, a couple of things that we'd highlight about LA is, number one, the mansion tax is now behind us. So it's not something that it's obviously going to continue to impact the market, but it's not going to be a headwind any longer. It's now priced into 2023 numbers. And then you have massive infrastructure expansion in advance of the Olympics. You got a Super Bowl coming. You also have the World Cup and the Olympics, all really positive. Seattle has had a weak recovery to date, and they've got outsized growth from foreign inbound travelers, especially Asian, as well as a really strong convention calendar, which we think positions Seattle, plus really low expectations for Seattle right now. It's just kind of an out of consensus market that we think is going to be a winner over the next few years. On the bottom performers: Boston, Chicago, Austin, that's a tough convention calendar. Boston, we talked about those difficult comps. Chicago, you've got elevated expenses, and more importantly, you've got that mansion tax that's coming up for a voter referendum that we think is going to add about 75 basis points to cap rates going forward, which is going to take a big hit on hotel values there. Now, before we start the Q&A, a couple things I want to highlight real quickly. We're going to talk a little about San Antonio. I am getting so many questions about San Antonio from my clients, from non-clients, all of the above. The past 3 months, there must have been 20 different clients or non-clients that reached out trying to understand San Antonio and our views on San Antonio. Here's how we think about San Antonio and how we analyze San Antonio. First of all, we break down what are the drivers of the economy. And the reality is this is an economy that's heavily influenced by the military and defense sectors. 90,000 direct employees at the military bases, almost 200,000 employed directly in the military or indirectly in the military sector. Over 20% of local employment is tied to the military. 13% of the economic output from the MSA comes from the federal government. That translates into a very stable base that generates a stable amount of hotel demand. Stability is a good thing. It is not a bad thing. Stability is great, but stability is not growth, right? And stability is the opposite of growth, right? It is a steady eddy. The other thing to keep in mind is that this is a lower educated workforce. There's a limited number of higher income jobs, which translates into few corporate relocations relative to other large cities. Household income growth is going to lag the national average over the next few years. So you don't see that acceleration or improvement in corporate transient demand there like you do in a Dallas or in an Austin or some of those other Texan markets. Hotel demand drivers, right? This is predominantly a domestic leisure market, right? 2022 RevPAR was 8% above 2019 levels. Foreign travelers, like I said, is only about 1% of 2019 total room nights sold. RevPAR was down 5% in the second quarter of 23, down almost 9% in the third quarter. It was up 0.5% in the fourth quarter. Gives you a sense of kind of where trends have been and kind of the challenges of domestic leisure travel, right? The convention center accounts for less than 5% of market demand. It's pacing up 8% in 2024. That's encouraging, but it's still below 2019 levels. And San Antonio will host the Final Four in 2025. That's a positive. We put all of that together, build out a RevPAR forecast model that you see right here, the 99.6% R squared, all of these factors that drive the model, include supply, convention calendar, unemployment rate, jobs, household income, office employment, and exchange rates. Why do we care about exchange rates if it doesn't get much foreign travel? Great question. It's because it gets U.S. domestic leisure travel. And as we talked about before, if foreign destinations are on sale, people are less likely to travel domestically. If foreign destinations are priced at a premium, people are more likely to stay local. So here's a situation where it doesn't get a lot of foreign travel, but foreign exchange rates impact U.S. leisure travel to San Antonio. And then if you look at a breakdown of where the RevPAR growth is going to be strongest over the next 5 years, this is a heat map from our GIS application, which is an amazing tool. If you guys haven't seen it, I strongly recommend checking it out. You can reach out to us for a demo where you can see where RevPAR growth is going to be strongest across any market. 217,000 census block groups in the U.S., all mapped out for RevPAR. Anyone that has a hotel, we have a RevPAR estimate and RevPAR growth for over the next 5 years. You can see some of the key factors that we think are going to drive outsized growth, like the Rocket La Cantera, Civic Park and Hemisphere development, and obviously the convention center. Again, darker RevPAR growth is stronger. And what does all this translate into? A forecast for San Antonio RevPAR that we think is a little different than what other people are coming to. So at the end of the day, on the surface, the market looks like it's poised for exceptional growth, right? The factors that drive the local economy are all looking really strong. However, as we just talked about, those factors don't necessarily drive hotel demand. It's more stability oriented, right? So if you look at the 2023 actual for San Antonio generated RevPAR growth in 2023 of negative 1.7%. Going into 2023, we had forecasted RevPAR growth of negative 2.3. The leading provider forecast was positive 10.6. We were obviously much closer, right? Then if you look at January 2024, just January 2024, this month, San Antonio came in at negative 1.5%. We don't forecast for January, but for the first quarter, we forecasted negative 2.6. Pretty reasonable relative to that negative 1.5. That leading provider, plus 21.2%. For the full year 2024, we were at negative 2.8. They were at 18.6%. So my question to you is, if you're building budgets, you're revenue managing and pricing inventory to leverage, to understand what your market is going to do, or you're underwriting a multi-million-dollar investment, which of these forecasts are you really willing to rely on to help you make smart decisions? To me, I think the answer is pretty clear, but it's amazing how many questions that we've gotten over the past 90 days about this market specifically, because the divergence is so extreme. And the divergence is extreme because we understand what drives the hotel demand in the market, like we do for every market that we track. And it translates into better forecasts like you see with San Antonio. Now, with that, what I'll share with you guys is what we do at LARC. Primary focus is our quarterly market intelligence reports, where we issue those on a quarterly basis for 61 cities, the US overall. We do commissioned work where we'll do forecasts for any market, any submarket, any price class, totally customizable for budgets, for transactions, you name it, with a pretty quick turnaround time. And then we have our LARC GIS web-based application, which is a revolutionary tool for hotel budgeting with RevPAR forecasts for over 19,000 unique geographies. And then within that, we've now launched location intelligence reports where you can pull data about a specific location without having to subscribe to LARC GIS. And with that, I am going to stop there. You guys can load in your questions. Katie's going to go ahead and start to field the questions. Like I mentioned before, we are going to send out the slide deck. So fear not, you will get that. And we will also post the recording on our website. So if you got on late, don't worry. You'll be able to you can watch what you missed from our website. And with that, Katie, why don't you go ahead and let me know where things look.
Sounds good. Good afternoon, everybody. Got a few questions here. So the first one, given favorable convention center bookings and limited new supply, do you foresee multi-year growth for the New Orleans, specifically CBD French Quarter market, despite recent lackluster performance?
Yeah, New Orleans is a market that's really fueled by two core components. It is convention and group business and domestic leisure demand. The group business is really strong, and that should support pricing power. The leisure component, I think, is a little trickier and more difficult to gauge. We think you'll see some strength in 2024, largely tied to that convention center and the strength there. But if we don't see improving leisure demand in the years that follow, I'm not confident that you're going to see continued strength across the market. We'll need to see that continue to play out.
And is that really Portland ME or Portland, Oregon?
It depends what you were looking at. We have Portland ME and Portland, Oregon on there.
Is business travel back to pre-COVID levels? How's that looking?
Business travel is definitely not back to pre-COVID levels. We estimate it's somewhere around 10 to 15% below pre-COVID levels. And we think in 2024, you're going to get to about 10% below, continued gradual pickup, but nothing that exciting there.
What factors do you believe have most contributed to the softness of the economy segment recently?
I think that's very clear. Domestic leisure demand, as we've talked about, the economy segment is heavily driven by domestic leisure demand. You don't have bankers or consultants staying at the Motel 6 on corporate travel, and the economy segment doesn't really get a lot of group demand, doesn't have any meeting space, things like that. So it's very domestic leisure oriented. As we've highlighted, the health of the U.S. consumer has been soft over the past 6 to 9 months, and we think that continues.
How does the election affect group bookings, if at all?
Yeah, I think it will. And this is the fear, especially as we look to 2025. I think it's going to have less impact over the next 6 months and more impact, call it in 4Q 2024 into 2025, where businesses just are reluctant to spend as much money. And we walked through that earlier with the decline in year-over-year growth in business investment in 5 of the last 6 presidential election years and the last 4 presidential election years. We think we'll see that again this year, which is going to impact corporations spending money, which certainly plays a role in group travel. So we think there's risk. That's one of the reasons why we think that group travel or convention bookings in 2025 will remain below 2024 levels.
How will the lawsuit against CoStar affect your use of their data in the future?
Well, we'll see if that lawsuit, translates into anything beyond a class action suit that's like when Kramer spilled coffee on himself or something else. I'm not I am personally, and I don't know the details of the lawsuit or the information that's being used, but my view is historical performance does not drive hotel pricing going forward. You have to actually do something else with it. So I don't know that knowing what it would be one thing if CoStar provided forward booking data of competitors to one another, but they don't. They just provide historical data. So I think that to me, it's a very tough argument to make. But that being said, I am no legal expert, so we will see how that unfolds, but it's not something that we're too focused on right now.
I've heard that the tightest correlation between a macroeconomic metric and RevPAR is new housing starts. Have you looked at that?
We look at that all the time. It is not very relevant across the US. There are certain markets where it is, but you also have to look at kind of long-term lead times. I would also say new housing starts is more relevant to population growth, which in certain markets is relevant for hotel performance, but in a lot of markets is not at all.
How does attendance levels at 2023 citywide conventions compare to that of 2019? What are you projecting the attendance level to be in 2024?
2023 was about 5% below 2019 levels. 2024 is 3% above 2023, so it's pretty close to 2019 levels.
What are your views on San Francisco's ongoing recovery, and when do you expect a full recovery to pre-COVID RevPAR?
Mm, long time is the short answer. We don't have our forecast for San Francisco doesn't incorporate a full recovery to 2019 RevPAR by 2028. Not saying it's not going to get there, but we don't see it within the next 5 years. We think there's going to continue to be an uptick in San Francisco, as you saw in the slide deck. San Francisco is one of our top RevPAR growth markets in 2024, despite the fact that the convention calendar is tough in 2024, as we see more corporate transient demand coming back in 2024. But see, and foreign inbound travel, especially from Asia.
What is the driver of upside demand in Palm Beach?
Oh, sure. I think that what's really interesting about Palm Beach right now is it's going through a massive shift where you're seeing a lot of financial services, Fortune 500 companies relocating to Palm Beach, and it's creating this corporate transient segment that wasn't there 5 years ago. And that's opening up a whole slew of business opportunities, whether you're talking about shoulder nights, off season, all these factors that are creating much better pricing in the off season, and B, more compression in season, which is very, very positive for that market. We think it's a market that's got a lot of legs over the next few years. We're pretty big fans.
Any particular major markets you are concerned about from a near-term supply perspective?
I wouldn't say there's any major markets that we are overly concerned about from a supply perspective. I think generally speaking, supply is muted across the country. That being said, some markets will have more supply than others. Raleigh is one of the higher supply growth markets. We think they'll absorb it. Nashville, while supply is high relative to national levels, well below what it's been over the past few years, and we think they've been able to absorb it pretty well over the past few years, so we don't see too many concerns there. New York's got a decent amount of supply coming online, but at the same time they've had a lot of supply come offline, so we're not overly concerned about that supply. So basically every market that you look at that has a lot of supply under construction, it's nowhere near where we've seen it in the recent past, even if it's well above national levels.
How is the performance looking for January and February 2024? Seems in the top markets, it is softer pace on the books than expected.
Yeah, 2024 is, look, I mean, I think the right people to ask would be, we're a forecasting platform. So, I'd get that data from STR or CoStar or whoever you get that data from. But our understanding is January was in line with our expectations for the first quarter, which point to kind of 2.5% RevPAR growth fueled by ADR with negative occupancy, like we showed in our first quarter outlook.
How do these forecasts impact the select service segment, particularly in small metro town suburban markets?
I think national forecasts play a role, but obviously, as you're looking at, hotel real estate is a street corner, market, submarket, location by location business, and the national forecast is a great benchmark. But if you're looking for a benchmark on a specific submarket or asset, then you should talk to us about something more specific to that meets your needs.
What are some predictions for OCC/supply in hotter climates during busy months? Occupancy. It was all caps. At first I said as weather becomes more erratic, as in markets in hotter climates seeing less demand, less leisure travel to these places.
Yeah, I think there's the risk that you will see climate impact having a long-term effect on leisure travel to hotter locations. However, just to give you some perspective, leisure travel to South Florida, to Arizona, were at all-time highs in 2021, 2022. Obviously, they've pulled back from that, but that's just more about normalization from those all-time highs. We're not seeing that impact in the short term. We think those are real trends that people need to be mindful of, but they aren't 3 to 5 year, 3 months, 6 months, 2 year, even 5 year trends. They're 10 to 20 year trends, and we don't go out that far.
How do you see the Sarasota, Florida market in 2024?
Not a market that we issue quarterly forecasts for, so I don't want to comment on it. What I will say is that we are big fans of the whole Florida Gulf Coast in general over the long term. In the short term, we think Sarasota is a market that's very domestic leisure dominated, and we just talked about what the challenges from domestic leisure is for 2024. So, I would imagine that we're not overly positive for 2024, but long term, that's a different story. We really like that whole area long term. Like I said, we issue forecasts for things like that on a commissioned basis for specific clients whenever they're interested.
And as of right now, this is the last question. What are your thoughts on Hilton and IHG moving into the economy/mid-scale segments with Spark and Gardner? Will this drive limited service RevPAR down and/or economy RevPAR up?
Yeah, I think adding major brands to those segments is only going to bring RevPAR higher as you bring more of those loyalty program members to those segments, which is a positive. I also think that you're going to see, so you should see that general impact being a positive, not a negative. It may pressure some hotels that don't have those big name brands because the demand tends to migrate to the Hiltons or the Wyndhams, et cetera. But generally speaking, we think it's positive for the segment.
And that's the last question.
Wonderful. Well, we appreciate you guys all taking the time to join us in the webinar. We will circulate the slide deck. And again, as we posted back on our website after the call, once we get it downloaded and everything. But if anybody has any other questions and wants to learn more about how we can be helpful to you, please feel free to reach out. Information at LARC Analytics is the easiest way to get a hold of us. Thank you very much and have a wonderful, wonderful day.